guys, welcome to this Moneycontrol live stream. Well, in this live stream, we'll be talking about how the markets are, faring. In fact, how the broader markets have seen such a sharp sell-off over the last 3 sessions. In fact, today, of course, is a day of relief. We're seeing some bit of green on the screen, and that's, something that has come as a bit of a relief. But, the Smallcap Index, it has lost somewhere around 12% from its peak. Although, one would argue that after an 80% kind of an up move in the last 1 year, a 12% kind of a downtick is nothing but a healthy correction. But that's something that, we will be discussing with our guests, given the kind of, given the fact that the correction has happened in just a matter of days. So is it something that one should be really worried about? Is it, a bubble? Because, regulators have also pointed out that there is froth building in the broader end of the markets, and that there should be an investor protection policy in place when it comes to mid and small cap funds as well. So to put into perspective, how one should be reading into the broader market sell-off, how one should be looking at their portfolios, reading their portfolios, and what should one be expecting from the results of the stress test mandated by AMFI and SEBI that will be coming out tomorrow. I have 2 very special guests with me today. Joining me is Ajay Bagga and Hemang Jani, prominent market voices there. Great to have you guys on the show, gentlemen. Ajay, let me come to you first. The kind of sell-off that we have seen, it has been the talk of the town, right? And it has sent, the bulls scurrying, so to say. But would you be, would you go as far as calling it a bubble, or would you just call it a healthy correction? Because 80%, that's the kind of rally we saw in the small cap index over the last 1 year.
Yeah, Nandita, I would say it's a correction on the way, and a lot of people are blaming the regulatory action. But, I would say regulatory action comes from a lot of dimensions, lot of perspectives. They have more information than we as investors have. And if they are, taking some action towards market stability, we should welcome that. And if based on some statements, the markets react so strongly, then clearly there is something wrong with the market sentiment. Because you look at the macro, you look at corporate earnings growth, you look at the infrastructure push, you look at the political stability. We are checkmarking most factors that drive markets upwards. So I would say it's more healthy correction that came in. And if it stays for some time, so be it. But I would say after such a strong upward surge in the markets, it's but to be expected. When markets are at all-time highs, you will see these kind of moves, and then the markets digest it and move on with continued, as corporate earnings continue to grow. You will see the markets rewarding those companies. So nothing to be very worried about this. Is what I would say in a nutshell.
Right. Hemang, coming to you, would you concur with Ajay's view that, this is a healthy correction, one that perhaps will separate the men from the boys, right? And of course, yesterday we had comments coming in from Uday Kotak as well. Mr. Kotak said that, there may be froth, maybe you could call it bubbly, but there's no bubble as such. Would you concur with that view?
Let's make things very simple. That whenever you see certain pockets and themes, showing leadership in the bull market, okay, there is going to be some excesses, and people can have their own perceptions about whether it's bubble or it's excess, or whatever it may be. But that is how the bull markets operate, right? So whenever you see excesses, in terms of valuations, in terms of funds chasing certain pockets, there is bound to be certain amount of cleanup, as we call it, and we may attribute any reason. You may call it regulatory, you may call it March ending effect, but that's a normal market cycle. Now the point is that what at the investor level, what happens is that while the index may have corrected just maybe 2-3% from the top, but the portfolio level damage is like extremely high. So it's important to how to deal with those kind of drawdowns and volatility. I don't think the market is showing any weird kind of a movement. It's a normal thing, and if you are a little better prepared in position to take advantage of it, surely it will be, it will give you great opportunities also. But I think overall, as Ajay very nicely put out, things are looking good in terms of earnings picture. Globally, we are seeing of good amount of stability. Just to give you an example, as high a deal as 16,000 crore ITC got lapped up like this. So that is a kind of appetite which is there in the market. So I don't think liquidity by itself is a issue.
Right, Ajay, would you rule out a deeper correction like we saw in 2018? Because at that point of time as well, the small cap index had rallied somewhere around 65% in the matter of a year, but then thereafter it corrected somewhere around 45%. Would you rule out that kind of a deep correction now?
No, in the markets, you can't rule out anything, Nandita. That is very clear, and no one can consistently, accurately forecast. So we are just talking probabilities. The difference now is that the earnings are there. The macro is very strong. The global scenario, if you see this year, 200 central banks will be cutting rates. So when you are cutting rates, normally rate cuts happen when there is a recession. This time it will be normalization of policy. So from a very restrictive policy, central banks are coming towards more normality without a global recession. So it's going to be a very interesting year that way. But rate cuts normally with a time lag, normally because they happen on a recession. That's why the first 2 3 months markets are not very sanguine with a rate cut, but then they take off. This time around, I think in anticipation of rate cuts, right from last December, we have seen global markets rallying up. So I would say it's a very different situation, but it could be a famous last word. So I would not say okay, it won't fall further. Who knows? Any geopolitical risk, any regulatory action. But I even with respect to the SEBI stress test, when the fund managers are creating portfolios, they do look at it. I remember 2008 when the markets virtually shut down with 60% falls. That time in the global financial crisis, an FII told me that when we came in, you were as big as Taiwan, and now when we are trying to get out, the exit has narrowed to a Thailand kind of a scenario. As Hemang mentioned, such a big block deal happened, and it got absorbed by very renowned investors, institutional investors stepped in and could absorb that. So it's a different market, but you have to see. So when portfolios are created, you take the worst case scenario that what will be the impact cost when the volumes go down very dramatically in a sell-off, when there are no buyers on the other side, and there is a mutual fund has to give liquidity. So that is the stress test that that SEBI has mandated, and I'm sure each company, each institutional investor has in-house policies to take care of that. We used to have risk managers sitting there who are looking at the WAR at a portfolio level and what has happened in the past and what kind of volumes would be there. They avoid these stocks which are in ASM frameworks and stuff like that. So I'm not expecting much from there. 7 funds on their own have put a sub-control in terms of large inflows. So mostly it is self-regulation and in enlightened self-interest, the funds have pretty strong robust mechanisms. It's not 2008 quite clearly.
Right, Hemang, coming to you, what are your own expectations from the stress test results, and how should investors be reading into it? Just for the benefit of our viewers, what would you be watching out for from the stress test results tomorrow?
Anita, I think yesterday what we went through was some sort of a stress test, right? It was a live stress test that one can think of. I think the reality is that when you are dealing with mid caps and small caps, the liquidity and the price impact, these are the essential risks, and you may do many things, and proactively this time for a change, the regulator is actually coming up with such suggestions, which is a great thing. But we have to bear this in mind that whenever there is going to be certain amount of sell-off for any reason, the impact on certain pockets will be much more, which you cannot wish away. I don't think there is going to be materially negative thing. SEBI has its own limitations in terms of what can be, done in terms of maintaining certain sanctity and stability and stuff. At the end of the day, if mutual funds keep getting funds in certain themes like mid caps and small caps, they have to deploy. So there is very little that you can do beyond a point.
Right, I also want to ask you, Hemang, ICICI Pru has, stopped lump sum investments into mid and small cap mutual funds. Other funds have also done the same, right? To curb excessive allocation to small caps. But how worried should investors be about this?
So proactively, some funds have started kind of cutting down on getting more flows either through lump sum. Some funds have also stopped altogether. So I think that is like each fund manager's fund house's choice. But I think at an investor level, investors are more driven by the returns. Today, if I have to invest, I look at which are the best performing, mutual funds in certain categories. And when I see numbers, I'm more, tempted to put into those categories. So unless the maturity and understanding at the investor level happens, we may actually have a situation where there is a certain amount of, high AUM and high performance driven, funds getting more money. And you will go through drawdowns also. I don't think there are easy answers to this.
Right. Let me come to you, Ajay, now. Talking about the entire crackdown on the NBFC space, right? Of course, IFL Finance, JM Financial. Today, in fact, if you see Federal Bank and South Indian Bank, both the stocks are under pressure, of course, because, they won't be onboarding new customers with respect to co-branded credit cards, right? So, lots of, like regulatory overhang on the entire NBFC and smaller PSU banking end. How would you approach this whole space after all the news flow?
See, from a credit perspective, it's a beautiful product, the IPO, because Nandita, you lend to the customer, you're controlling the bank account, you're controlling the demat account. If the allocation doesn't happen, the ASBA gets revoked and automatically money comes back to you. If there are shares allotted, then you ask the customer to bring in funds or you sell it on their behalf, and there is no credit risk virtually. When the credit risk comes is if there is a bad listing, as we saw in 2008 with some large listings, and that broke the back of a lot of NBFCs at that time. RBI had moved, under YV Reddy and then Subbarao ji, RBI had moved faster and got the banks out of real estate exposure, but this IPO exposure was still to some extent. So this time RBI is trying to move in fast. These policies have been there for donkey's years. This is how the industry operates with POAs from customers. So from a credit perspective, there is not much difference between A lender and B lender. What was different, what they are talking about, that it's inter-regulator coordination, where they have seen that there is a lot of mule accounts being used to hike the subscriptions, and maybe you then put in the same pan on multiple applications, which will get rejected, things like that. So let's see the whole report. The problem is when action happens without the whole report in the public domain, the imaginations go very lurid, Nandita. That's the trouble. But what RBI is doing is always welcome for systemic stability. Again, as I'm saying, they have much more data than any of us. And that's what I keep counseling anybody that talks against regulators, that it's a tough job, but they have more knowledge, more data points than any of us. Yes, communication can be better. We should not imagine that we are Alan Greenspans of 96. He was also wrong for four full years before the dot-com crash came by. So anyone who followed his advice in 96 would have lost out on one of the biggest bull runs in history. So I don't think regulators should comment on valuations. That is not right. A bubble or not a bubble is only in retrospect we will know. Today, yes, by history, mid cap, small cap, 1 year forward Ps are on the higher side. But is one standard deviation okay or three standard deviation okay? With what kind of earnings growth is it justifiable? There are so many things that go into a valuation. And I think that you should stay away from. If you are seeing pump and dump, if you are seeing operators working, that you should catch up. But rest of it, I think, should be left to the markets with very clear communication.
That's a
That would be my perspective.
That's a very interesting point you've made, Ajay. I think which is why you had Uday Kotak coming out and saying that perhaps froth is there, but there is no bubble. But Hemang, coming to you now, as people have been using the word froth over the last few weeks, right? Where exactly do you see froth building in the mid cap space, and where, after the kind of correction that we've seen, where is value emerging now post the sell-off?
So, Nandita, at a broader level, I do feel that the valuations of mid caps, if they are at a 15-20% higher than the large caps, in small caps also, they are higher. Obviously, there is a case of, excess built up over there. And sometimes, it may not be very healthy, particularly when you go through a negative event or there is a liquidity crunch, etc. But how long that will continue is something that, we cannot really, sitting over here decide, because market is too big, and depending upon liquidity flows, earnings and many other factors, this may go on for an extended period of time. Case in point being PSUs. I did not think that, many people in the market expected such a big re-rating of PSUs, where that for donkey's years these companies have been operating and there was not a materially different earnings trajectory, just that there was, a little bit of narrative around railways, defense, etc., etc. So market can surprise you, and the re-rating can also surprise you. We have to be modest enough to accept that. I think the simple thing one can do at this point of time is to really make a list of stocks, maybe 30, 40 stocks, how much they have corrected from the top, which companies have come out with better results, and when there is a valuation comfort. So we did try to do that exercise yesterday because of the kind of fall that we saw, and some names I can highlight for you just for the reference. So APL Apollo, Lemon Tree, some of the healthcare names like Max Health, Nosin. These are the companies which have corrected substantially from the 52-week high, where the numbers were good. We have a slightly better outlook. So these are the names that one can really look at. But it would be good if investors do this exercise on their own.
A lot of MFs have, mutual funds have exited quite a few PSU names as well, right? According to Nuvama, they have exited the likes of, SJVN is one. And there are a couple more that they have. But there, on the other hand, there's been buying in stocks like IRCTC. And if you look at the oil PSUs, Hemang, street is fairly divided with respect to where BPCL, HPCL, oil PSUs are headed, right? What are your own thoughts as within the PSU pack? Do you think, oil PSUs have more legroom now?
Nandita, my feel is that you should not be overweight across PSUs. Within oil PSUs, I think GAIL and IOC we think that they have slightly better earnings trajectory. Valuation comfort is also there. At the same time, the railways PSUs, I really see no reason why there should be such a high valuation that they should get. Yes, we have some narrative around this Vande Bharat, etc. But I don't think there is a case for a substantial earnings-driven re-rating that one can really think of. So you have to do a little bit of hard work in terms of what are the pockets where there is a genuine earnings-driven re-rating which is happening, as against just a narrative.
Ajay, for PSU banks, the smaller names, do you think there are excesses there and the rally there is not backed by fundamentals?
Yeah, again, if you take a 15-year, 12-year, 10-year kind of perspective, these are value destroyers. So it's just that over the last 2 years, there has been a big, the cleanup finally has caught up with them. And then over the last 1.5 years, we saw good performance. But I would be careful. I would totally agree with Hemang. The PSU story has been overdone, overhyped, and oversold. And quietly, the funds have been exiting. So we should be careful where the institutional investors are exiting. When you have an option of a private player in the same sector, in the similar field, yes, the valuation of the private player will be much higher given the nature but that's rewarding their flexibility, that's rewarding their operational excellence. So if you have a choice between the two, go for the private player is what I would say. And quite clearly, over time, the government should look at. There has been privatization by stealth, like in airlines, like in telecom, like in a lot of other sectors. Similarly, I think the business of government is not business, and they will always be suboptimal in asset in equity allocation, capital allocation. Might be better to cut these companies loose and let them be run by professional managers, professional boards, like the big banks in the world, Nandita. Hardly there is no promoter as such. Yes, Prince Alwaleed might own 9% of a foreign bank, but they are all board-driven, management-driven companies. I think that should be the future rather than keeping them under ministries. And then they have a big overhang, and you have to get ruling party satraps as board of directors. You have to provide cars, you have to provide guest houses, and act on all those. All those keep on adding up. Rather, if you split them into 5, 10 very nimble-footed management and board-driven companies, they could really create magic, and government can hold small portions in it, maybe above 26% to ensure that some mandates they keep. But that could be a better option and especially for retail investors, leave it to the fund managers, leave it to your advisor, or you want to do direct equity yourself, then go for the private player in the same sector. Will be more expensive, but you will be rewarded better.
Right, gentlemen, last couple of questions really. Ajay, of course, over the last 1 month, or in fact, even if you look at the YTD picture, large caps have taken the lead now, vis-a-vis the small cap index. So do you think here on that will be the case? Of course, with all the regulations, regulatory issues, stress tests and what have you, it's the time for large caps to come forward and take the lead here on. Would you say that will be the trend?
Beginning of the year, I was very clear because of what you mentioned earlier, the reversion to mean. And Hemang can bear that out with data. He does a lot of analysis. But I was saying the same, that stick to quality and come back into large caps. Now, I feel after the correction, what is really, we have to see this behavior yet, Nandita. What is happening? A large portion of that SIP flow is still coming into small cap, mid cap funds. So will that stop? Will that change complexion to large cap? I don't know. So we'll have to see that. What we see is that March 2020, when the markets tanked, the retail and especially the SIP ones were the resilient. So when people make losses in the market, they automatically become long-term investors. It's very painful to go and book the loss. That only the institutional players are able to do because they are program based. So at X level, they have to cut their loss. A retail investor keeps on sitting on hope. So if these SIPs continue, those 19,000 crores, and a large portion is coming in mid and small, I think it will stay. The incremental money will keep on entering that, no matter what we keep talking. But I think this year, by reversion to mean, probably you'll be better off in the large cap and the quality names.
Hemang, you also want to comment on this one? Would the trend reverse here on, or do you think mid and small caps will continue to be the cynosure of all eyes?
Points I would like to make here, Nandita. When we look at the broader performance, of course, the Nifty 500, just to share data, is up almost about 40% in last 1 year, whereas Nifty is up 30%. But this 38%, there are 500 underlying companies, and each theme, each pocket will have its own sort of, performance. So I would think that given the fact that already there is such a big outperformance by the broader market, and on a higher base, even when you're running with very high earning expectations, there is a case for some sort of a disappointment, let's say over the next 2 or 3 quarters. Also, we have election year in India, in US, and maybe in other parts of the world. So it would be good to have slightly, large cap oriented portfolio, and deployment in parts would be more sensible rather than going too aggressive. And I do think that banks as a space are a better place, because private sector banks in any case have underperformed, and I do think that for next, let's say, 1 year or so, you will see better earnings along with asset quality for the banking sector. So banking is something that I'm more comfortable with.
Right, last question really, Hemang, to you. What about the IPO frenzy? Do you think, that would cool off a bit, given the fact that SEBI has also flagged off overvaluation when it comes to the SME IPO space, right? Do you think that momentum will slow down here on, or do you think the IPO market will continue to flourish?
I think IPO market has seen lots of ups and downs. At the end of the day, what we are seeing is that many investors at the time of listing are actually not making any substantial gains. You may have some IPOs which have done well. And in SME, what we are seeing is absolutely, we have never seen this kind of a trend, where you see some sort of a manipulation or some sort of a, money juggling which is happening. So I do think that regulator is doing the right thing by flagging off the practices in SME segment. IPO, we will have to, go by each company, its numbers, valuations, what kind of margin of safety you are working with. So it would be good to be selective there.
All right, that's the word, be selective when it comes to IPOs. Gentlemen, thanks a lot for taking out time. I think, we have overdone our time. But, appreciate your taking out time and such a short notice and sharing your thoughts with us and putting things into perspective for us. Well, with that, we've come to the end of this Moneycontrol live stream. Thanks a lot for tuning in, but you guys stay tuned for all your other news and updates on Moneycontrol.